Markets are bracing for key inflation and quarterly results this week. For insight on what's at stake for markets, let's bring in Emily Roland, Co-Chief Investment Strategist at John Hancock Investment Management. Serendipitous, Emily, that your very first note when you were pre-interviewed was a Warren Buffett quote. Did you know it was going to? Did you know you were going to come on right after we had a long conversation? And that is, the tide goes out. And I can't unsee it a lot of times, but the tide goes out and you see who you definitely don't want to see sometimes if they're not wearing a suit. And by that, you mean higher interest rates have costs for especially companies that are dependent on a low cost of capital, and they could be exposed as we're beginning to see.
Yeah, that's right, Joe. You can never go wrong with a Warren Buffett quote. So I can't wait for that 3-hour interview tomorrow. We're going to get a lot of good stuff out of that. But yeah, absolutely. This is what happens at the end of every cycle. The Fed raises interest rates until something breaks. And we never know when it's going to happen, but it involves companies that have binged on cheap debt, have issues, solvency issues, and we sort of left seeing who's got too much leverage, who's overly exposed to certain parts of the market. And that's the reason that we want to load up on high quality companies. We want to own companies with great balance sheets, a limited need to tap the capital markets in order to grow, and really stay away from those unprofitable growth at any price names that are out there today.
And that probably makes you're biased towards larger companies, mid caps, large caps for the most part.
Yeah, you're going to find a lot more quality up in market cap. So you look down, small cap companies, about 40% of the Russell 2000s unprofitable. Those types of areas of the market can do really well in an early cycle environment. We just don't think that we're there yet. So yes, moving up in market cap, mid cap really is the sweet spot for us in terms of having some risk in this market today. Look, you want to participate. The equity market's almost defying gravity right now in terms of the mismatch between what all of our macro signals are telling us. Yield curve inverted. We've got, the leading economic indicators at -6%, the manufacturing sector in the U.S. in a recession. And yet you see equity markets, especially areas like Europe, just showing incredible outperformance here. So we want to own some of that. We want to participate. We just want to lower the beta in the portfolio, get more defensive, emphasize quality, and ride out this very almost what's becoming an exhausting late cycle environment because it's never ending at this point.
With you calculate the forward PE at 18. It's not cheap, but it's not outrageous. You think revisions on earnings do they actually square with reality? Do they still need to come down more? And if it is 18, and if we had a lot of revisions already, would you characterize the S&P as grossly overvalued or kind of maybe just marginally overvalued if rates eventually do start coming down at the end of the year?
Well, at 18 times forward earnings, we are sort of bumping up on areas that have been hard to break out of before. So we've struggled to break out of this level. And we do think that earnings are probably a bit overly optimistic. You just look at what's expected in terms of Q1 earnings. There's 4 sectors that are slated to have positive earnings, and they are all the most cyclical sectors in the market: financials, industrials, energy, consumer discretionary. If you're looking for earnings growth, I think loading up on those more cyclical sectors, you're probably a bit overly optimistic to expect that. If you own higher quality sectors, technology, for example, expected to see more modest earnings growth, I think we can get there. We look at areas like utilities, more defensive parts of the healthcare sector as, again, having very reasonable earnings here. But I think 18 times is a pretty generous multiple on the market, given where we see the macro environment going. You've got to be really picky.
Okay, Emily, thank you. John Hancock on it. Thanks.